Well, good morning, everyone. After a lengthy couple of week absence with Glenn replacing me as the new superstar, you're stuck with me again. But as always, we've got the brilliant Doc. Good morning, Doc. How are you?
Yeah, good day, Graeme, and we've missed you all, and good to see you back. But we all know you're a busy man, but the property market stops for nobody, and that includes you.
That's true.
So here we are.
That's true. That's
here
true.
we are.
I feel like I've been on YouTube podcast vacay. I feel like I'm a bit out of the loop, watching the data, not being part of the data. So today will be interesting.
Yeah, refresher course for you, but I'm sure you're on top of everything as usual.
We'll see.
Well, it's been an interesting few weeks in your absence, and we've had Glenn taking over, which has been a good experience as well. But as I said, the market moves on. And happy spring, Graeme. You've come back for the spring selling season, which is now commenced.
Yeah.
Last Saturday,
I did,
of course.
And I did call that as this kicked in, I didn't think there'd be a lull. And you said, well, you might be right. We'll see. A few episodes ago, I said, I think winter won't be as dreary as we thought as far as property data and auction rates.
Yeah.
So I'm keen to see where we're tracking.
Well, you're 100% right. We actually had quite a robust winter, notwithstanding it was winter. And as usual, August started to pick up. And the back end of August was really positive, particularly in terms of the number of properties coming into the market, particularly the auction market. So sellers are pretty keen to test the market. And why wouldn't they be? Because there's plenty of buyers around. And we're just we've had our first weekend. Results were where they have been, and listing numbers continue to rise. So we look forward to what we usually see every year, and that's a positive spring market. And really, all markets are engaging at the moment. The one query is maybe Melbourne. Melbourne's been a little bit sideways the last few weekends, but Melbourne typically is a stronger upper price market during spring. And we've seen some early signs that higher priced properties are coming into the Melbourne market now. So next few weeks, we'll see if that gives the Melbourne market a bit of a tailwind. But that's our auction market, and we'll talk about that in some depth shortly. But of course, the big news this week has been the Reserve Bank's first spring decision for interest rates.
Yes.
And another pause.
And has Lowe left us on a low or a high? He's left us neutral.
Well, I think it's a high because, not that he should be blamed, but for higher interest rates. We've been a little bit questioning about the pauses because the data really hasn't supported it. I don't think the data really supports it still, but it's certainly heading in the direction which would make the Reserve Bank reasonably comfortable with another pause. And of course, that's, 4 pauses out of 5 months now. So it's really starting to build a sort of a head, this cycle. With the question is, maybe we won't see another rise. Maybe we've hit the top.
If anybody's thinking, I don't know, Doc, if we've hit the top, but I mean, if anyone's thinking about fixing right now, which we know the banks will bait people into, and we have hit the top and we do drop for any reason, geez, you'd be kicking yourself.
Yeah, there's a few interesting factors that we'll discuss today, which I think largely have been ignored, Graeme, in terms of how our economy is tracking at the moment. And it's not all roses, particularly in terms of real wages growth. And we'll look at that shortly. We'll discuss that shortly. So why don't we get started?
Let's rip in, Doc, and have a look at the actual data. Keen to see what's been happening in my absence, although I've been following it closely.
Oh, thank you. That's, of course, Graeme. It's what you do. And it's always, it pays, of course, buyers, sellers, everybody to be informed about the market going forward. And that's what we do here at My Housing Market in conjunction with Infinity, of course. And we're all about the current state, of course, particularly of our housing markets, because it's obviously more rewarding to know what's happening now rather than what happened 3 months ago, which is what we get from a lot of the commentary and the data that comes out. So my housing market, and of course pauses for interest rates again. It's becoming a tired headline, isn't it? But I'm sure it's a headline that's welcomed by mortgage holders, and I think it'll prove a positive fillip for our spring selling season. I think even if we had an interest rate increase, Graeme, it would have sort of been taken in the market stride to some degree, which really higher interest rates have been brushed aside over most of the past year because housing markets have really revived. It hasn't had the negative effect over the longer term that, was expected by many. And we're really going to get some positive growth this year in our housing markets, particularly the Sydney market going forward. So, as I said, I'm not sure even if we had got a rate increase that it would have slowed the market down, but it's got to be a positive, given those 12 interest rate increases we had from May last year, to have yet another pause, 3 in a row. And, that really does sort of consolidate the sense that we've sort of peaked at the moment, but I wouldn't be super confident about that. So rates on hold over September. That's not July. It should be September. So over September, we've seen rates on hold again. The latest data reveals an easing in economic activity that supports that recent rate pause. We've been saying that even though rates have been pausing, Graeme, that the data really hasn't supported it. The economy's remained strong. Inflation remains high. And really there was no particular justification for stopping increases in interest rates. But
what justification do we give them, Doc? If inflation's still in the 4s and 5s up there somewhere, see what you say today. Inflation's still in 4s and 5s and their target's 2 or 3. And all the other factors which you and I are aware of, I don't know what justification there is except for stopping the riots in the streets. Like what are they using to justify the pause?
Well, it's about the wait and see attitude. What they're concerned at is that the impact of interest rates isn't apparent in real time, that it takes some time to impact the economy, and that they don't want to go too hard and not realise that it's already having an effect. So they want to make sure that they haven't gone too hard, that they're not going to push the economy backwards. So this is just sort of a wait and see approach. And Graeme, it has worked to this point because we're still seeing some positive results in terms of the battle against inflation. But we have seen an easy.
Well, that comes back, Doc, to what you said before. The data is a little bit delayed compared to the data you provide. And they're looking at things typically, yes, we can see monthly, but they're making core decisions off quarterly in arrears data, right?
That's right. And this is the point. They're just wary of going too hard. But it's they say the challenges are there. It's not a perfect science. And, there's a lot of uncertainty around what is happening, not just now, but what has happened and whether those higher rates are impacting the economy as planned. But so far, they can sit back and really, I guess, justify their decisions to pause over the last few months in terms of the latest data. Now, we've had an easing in the labour market. The latest labour market data, Graeme, has shown us, which was the July market data, has shown us that unemployment rate increased from 3.5 to 3.7. So really big deal. It's still very, very low. We've sort of been floating between 3.7 and 3.5 over the last 6 months or further back than that. So it's still a very low number, near record low number of unemployed using the monthly survey of the unemployment rate. So it's still a very, very good number. Shows we have a booming economy still. But, it has eased slightly. And also other factors, not just the unemployment rate, have moved in the direction the Reserve Bank would be a bit more comfortable with. We actually saw a fall in the number of jobs over July, and we actually saw a rise in the number of unemployed. And also the participation rate just fell slightly, which meant there were fewer people coming into the workforce. But all in all, those numbers firstly, okay, it's still strong. And those falls in the number of employed and the rise in the number of unemployed has come following a very strong couple of months in terms of jobs growth and also falling unemployed numbers. So it's a bit of an adjustment process. But as we've discussed here also, Graeme, there is some issues over the ABS data. I'm not talking about the quality of the data, but it is, we're seeing this up and down month by month outcome with the key data, particularly the unemployment data, the labour market data. And again, we move back to that proposition that perhaps the seasonal adjustment models that aren't really working.
Yeah.
Yeah. And look, they concede that. The Reserve Bank concedes that there are issues because of the COVID lockdown, in terms of, because, the seasonal adjustment models measure back in time and they figure out which months are strong months, and then they figure out which months are weak months, and then they make adjustments in the following years according to those particular months. So,
and I think, Doctor, to put that in lay terms for the everyday listener at home in our community, it's almost like a handicap in a race, so to speak.
Exactly.
So the fastest person has to start right at the back, and the slowest person gets to start at the front, and it should average out to all finish together. Is that a simple way for people to understand what seasonally adjusting is going on there, or?
Yeah, absolutely. And the handicap is based on seasonal factors. Like, of course, January is a quiet month because we're all on holidays,
Yeah.
But, October and April, and May are strong months because we're all well and truly ensconced in our workplaces. And so what happens is that, when we get the January number, we give that a little bit of an easing. So we give that some higher outcomes because we want to balance that out with the overall average. And when we get to months like May and perhaps October, we take away from them because they're typically stronger anyway. And as you said, the plan for that is to have an even outcome. So any rises and falls are underlying rises and falls, not due to changes in seasonal patterns, right? So during COVID, of course, there were some months which typically would have been weaker, but were actually stronger because of coming out of lockdown. And then there were some months that were typically stronger, but they were weaker because they were in lockdown. So those models have had to be sort of taken with a grain of salt. So it'll take a year or two, Graeme, to get back to our normal seasonal model pattern of activity. And therefore, we need to look at this issue when we're looking at the seasonal adjustment models, So
Absolutely.
I'm not saying they're completely broken, but there's still some work to do.
They're definitely skewed, Doc. And like you say, for another year or two, there's been some unprecedented growth when everyone expected mayhem.
Yes.
So they are definitely skewed. You are right, and you've talked about this for a long time now. And I think you're right. At the next couple of years, it's going to take some settlement before we can rely upon adjusting it.
Yeah, that's right, Graeme. And but nonetheless, I think the big picture is clearly, despite these sort of the volatility of the last few months, that our economy is still very, very strong, Graeme. Yeah. This is one of the strongest economies we've ever had, and it continues to surprise on the upside. It's not just Australia. The US continues to surprise on the upside. It had another very strong month for its labour market, the US, Graeme, with jobs rising, wages rising still. But as I said, the data has supported the pause from the Reserve Bank, the recent data, an easing in our labour market, even though it's still very strong. We saw retail sales increase. We'll have a look at the data shortly. Retail sales increased by 0.5% over July. And although that was positive, it didn't offset the 0.8% fall over June. But the point, even though retail sales increased, the trend has eased this year. So the actual growth trend is starting to ease. And the thing about the retail sales data is it doesn't account for increased prices. So there's an inflation effect there as well. So it's probably overstating the growth in retail sales. But nonetheless, it sort of supports the Reserve Bank saying, okay, maybe interest rates are starting to work, but still a very strong number and still growing. And of course, we had the latest inflation data out last week, Graeme, for July, for the month of July, and that also saw a continuance of lower inflation. Now we'll look at that data shortly in a bit more depth, but that's the reasoning behind the Reserve Bank's decision to hold over September. Okay. And of course, absolutely good news, more good news for mortgagees after all those interest rate increases, 12 of them over the past year, well, from May last year. And of course, the spring housing market. There's no negative headlines out there, interest rates increase, even though I think they would have been largely shrugged off as they have been this year so far. I think that we at least we didn't have the headlines about, poor old mortgagee, poor old housing market, higher interest rates.
Well, here's an interesting one, Doc. You and I have laughed for the couple of years, and we like being right, not famous. But all the bank economists and the the journalists and the financial journalists are all like, crash, boom, dismay, the sky is falling. Yet the last couple of weeks, I won't name names, people will have seen them, housing market to grow at least 10% in Sydney, Melbourne and Brisbane this year. These are the same financial journalists and or bank economists specifically that expected 20, 30% crashes.
That's right. Which bank? I think, yeah.
They're only, so we've gone from a 20, 30% crash to 10% growth. So we're 30 to 40% wrong in our forecast?
Yeah, but it's the direction that's the problem, Graeme. It's one thing to miss out on the direction, one thing to miss out on the volume or the value.
Doc, if we grow 10% this year, and I said, look, Doc, you told me you were confident in mid-range growth of 5 or 6% for Sydney this year, and it grew 10. I think you're pretty good at your forecast. When they expect, like you say, when the direction's negative 20 or 30 and it's positive 10, they're playing a different sport in a wrong stratosphere.
Yeah, it is. And look, you've got to work. It's always toughest with forecasting to work against the cycle. I mean, at the moment, a 10-year-old could probably figure out that prices are rising and will continue to rise, just looking at the trend and the latest data. It's not rocket science, is it, Graeme?
No, it's not.
It's actually easy peasy. You just look at the trend and the growth rates and the fact that we're now moving into the strongest period of the year for growth. Those forecasts are, we've really moved on from that. And to be quite honest, Graeme, it's a little concerning that these, changes to forecasts have come so late when really we've had 6 or 7 months of growth, as we keep showing here, in house prices. And the Sydney market's already pushing towards 10%, and we're only through August. So, we've got, 4 months to go. And we're already at 8% increase this year so far in Sydney. And you've got to remember that Sydney prices were still falling over the back end of last year. So any growth will be accelerated because it will when we compare it to a year ago, because it will be comparing to a period of falling prices where we have a period of increased prices. But we're measuring from the yardstick of where they finished last year, and we're about 8% higher. And I think it's almost a no-brainer now that Sydney will get 10% plus. In fact, I think 10% is perhaps a little conservative for the Sydney market. Going forward.
I think I actually called earlier, Doc. I think you were saying 6, 7, 8 or somewhere mid-range.
Yeah,
and I remember on one of our YouTubes and podcasts, I said, I reckon 12% plus this year for Sydney.
Yeah, I think
I'll have to go check which episode.
Yeah, I think it'll be close to 12, Graeme. We're 8 now. I think it'll be close to 12. Might not just quite make it, but the Sydney market is still chugging along very nicely. Yep. Thank you. We'll look at the latest auction results soon, but all good news. So that's our interest rate story, which is a big tick again. Looks like we're in for a reasonable period of pause rates. I'm not sure why, and this is what I ask you, Graeme. Why would they decide to raise rates? I mean, it would really take some, significant,
Let's name the top couple of factors. Yeah, Doc, let's name the top couple of factors. If we went 1, 2, what would be 3 core changes? So would it be an unemployment rate? Would it be inflation? What would be the top 2 or 3 dot points that would encourage them or force them to increase rates that people should listen out for?
Well, I think there's only really one, Graeme, and that's inflation. I think if we got a reversal in the trend in inflation, they couldn't argue against that. Because they've been basically arguing against, well, we've got a strong economy. Well, we should be, raising rates in that. We've got, retail sales are still strong. Well, we should be still. It doesn't show that, activity is really quelled with higher rates. I think the inflation number would be the number. And, of course, that comes out monthly. So, on that logic, I don't think that's going to happen because our inflation is still too high, Graeme. It's sort of say, we've won, see you later, inflation, we've beaten you. It's still too high.
I was hoping for another 0.5% to hit it on the head to scare the shit out of everyone. Now, I don't wish that upon mortgage holders and renters who cop, but I really was hoping they'd hit it on the head to scare everyone and pull back on spending. But we just haven't got there.
Well, we're still the best part of 1% below where we were at the previous peak, Graeme, in 2012. Correct. This is still a very low interest rate. I know it's all relative and it still stings. When you get higher interest rates, but our rate is still relatively low. But there are other issues, Graeme, in the economy, which I think we need to discuss, and we'll do that after we look at the latest data that we've just sort of viewed there. Look, there's the chart for interest rates. You can see there, all of a sudden, we've got a nice head there on top of the cycle. We're still, as I said, 0.65% lower than where we were in 2011-12 at the peak there. But, it really looks like we've started to, certainly moving into which we have done, into a consolidated pause period. The Reserve Bank in its commentary said that Australia has passed its peak for inflation. Okay, that's a very high peak. And more declines in July. We'll have a look at that in a sec. But the Reserve Bank said it's still too high inflation. And will remain there for some time. So it concedes that inflation is high and yet it's pausing interest rates. Can't work that one out. While goods prices have eased and that's because of the adjustment now out of COVID lockdowns. That was always going to happen regardless of interest rates. Of course, services are rising briskly, and that's because people are bidding up their wages to cover services. And yet the wages data isn't being reflected, or the official wages data isn't reflected that. We actually saw a fall in the annual rate of wages growth from 3.7 to 3.6, which was mind-boggling.
I missed the memo because most of our business got a pay rise this week. I've gone the other way.
I'm not sure what's going on there, Graeme, but that's actually bad news for Australia. And I'll talk about that shortly. The fact that our wages growth has eased in a period of very high inflation and very low unemployment. So the problem here is real wages growth, and we'll look at that shortly. But the issue here is that there's a lot of mixed messages happening, and again, we have to look at the data. It's just a little counterintuitive that wages growth should be easing in a period where we've run out of workers. And as you suggested, many employers are having to pay significantly higher wages to retain their workforce. Now, I know Australia is lucky in the sense that it has in a sense that, or not lucky, but it's different, because it has typically annual wage reviews, right? Whereas in the US, they don't have that. You can just walk in and say, I want more money. And if the boss doesn't want to lose you, they've got to pay you more money. Now, that's a good thing for the worker. It's not so good for the worker when the boss can get rid of you or pay you less because he's got plenty of options or she's got plenty of options. But in Australia, you've got to wait a year. Now, that was originally sort of set up, those annual wage reviews. That system was set up to protect the worker. So they had at least a year guaranteed in their wages in that sense. You know what I mean? It meant that they could consolidate their productivity through the year. But of course, if we had those, annual wage reviews or those, instant wage reviews now, we'd have a different outcome in terms of wages. And that's why we're seeing the US have a much stronger growth in their wages. So the forecast for, and the Reserve Bank also mentioned that rent inflation is elevated, and that's a problem now. That's what's really pushing or helping to push inflation higher is house costs. But the forecast is that underlying inflation will get back to that 2 to 3% range in late 2025. That's 2 years away, mate. I'm like, what? It's like saying, well, we've got 2 years. What does it matter? We'll go up, we'll pause, we'll go up, we'll pause. We've got to see, gee whiz, you'd be wanting to get, I would have thought, a little bit closer to getting the target than 2 years away. But it has conceded that some further tightening, it says this every month, may be required to make sure inflation gets back to the target in a reasonable time frame. But that'll depend on the data and how things sort of change. So that's a sort of get out of jail card. So we also had, we'll get back onto that other key data in a sec, Graeme, but we had home building approvals out for July. We had that out last week. Again, home building approvals were down 8.1%. Units fell 15.8%. Houses were flat, 0.1%. And Victoria was down sharply by 18.3%.
This is some pretty concerning data from my perspective. Well, sorry, for Australian families. How concerning do you find this? And this is just approvals. This isn't starts. This is just approvals.
That's right. That's right. So this is a wish list in a sense. It's not what's going to actually happen, and the wish list is falling, and it is it's chronically depressed, and again we've seen more initiatives from governments to try to fix this. It's not going to be fixed. The Commonwealth government is giving state governments incentives now to accelerate their planning issues, but it's still not in my backyard energy that keeps a lot of particularly middle and higher density development out of middle range suburbs where people want to live. And that's not going to change anytime soon. We can certainly try to cut the red tape. And there's a lot of red tape and green tape, particularly in state governments in terms of development, Graeme, which holds things back. Now, we could sort of improve that process, but it's really not going to get to the level where we're going to offset where we're going to offset depressed levels of building. And we just have to look at the trends to see that. You can see the recent trend for monthly home building approvals, how that continues to fall. We had a big rise in units a couple of months ago in Sydney, which acted to stabilise the trend. But that was a one-off development of over 4,000 units. And and those things come and go in the unit market. But again, it's just an approval. It's not a completion. We can see it. That units down sharply over the month. Overall, 6.1% fall in dwellings. Houses up just 0.1%. But when we look over the longer periods, the year to date and the full year, we can see how housing continues to crash. New housing numbers continue to crash, even though we're moving beyond the period of the home build allowance. And that's the big picture there, Graeme. You can see this is our building trend for capital cities. This is capital cities over a year, taken month by month. So this is the underlying annual trend, and we're continuing to fall away, and we're well below where we were at our peak way back in 2016. Of course, that's why we have higher rents. Just before we get off the building issues, Graeme, a couple of other things that I thought were interesting that came out of that conference from governments regarding the issues of building. Of course, they've now upped their target to 1.25 million, 1.2 million over the next 5 years. I don't think they've even met the first year's target. So
I don't think they've done anything to go towards it except talk about it.
Well, that's right, and I think it's sort of interesting. They're saying, well, we're giving some incentives to state governments to improve their planning processes and help with more building. Now, that's like saying, well, don't blame us, blame the state governments. We've given them this money.
Let's just remove some restrictions and take some red tape away and start to introduce some types of developments that could be considered conforming and don't have a gazillion years wait process to get approved, and really remove some of the red tape and palaver.
Yeah, and look, the other issue which we constantly speak about here is high building costs. That's also means that a lot of these approvals don't become commencements because builders can't afford to make or can't make a profit from them. So they have to just put them on hold.
Yeah. And that's a big one, Doc. I can't tell you how many development sites I've seen coming to market that people are walking away from, even that were fully sold off the plan, because it's just not feasible. Or the biggest one, Doc, they can't get a builder. They can't get anyone to build it.
Next week, Graeme, we're going to have our August rent report. Very exciting, as it always is. And we'll discuss some of the proposals or discussions that the government's had regarding how to, and this is all about, more dwellings is about helping renters, obviously, more stock. But they're now starting to talk about, firstly, they said no rent freezes, that's it. Well, thank the Lord for that. Finally, they've said, no, it doesn't work, which we've been saying here for months and months. So, so that's the first thing that they've said, no to rent freezes. And we said that would happen. Well, we hope that would happen because they said actually it hurts the tenant in the long run. So, and we know that.
Common sense prevailed. That's a change. That's good.
Yeah, I think that they realise that they're, that where it's been tried in other jurisdictions in other countries, it's actually been the tenants who've been saying, get rid of the rent freeze because it made things actually worse for them than better. So nobody was winning. But I thought it was interesting that there were actually some comments, Graeme, and hang on to your hat, mate. They said,
don't tell me it's about build to rent.
No, that doesn't work either. But what they said was, why don't we think about giving some incentives to investors?
Hallelujah. Wow, sorry, hang on. I got to be excited. Why don't we incentivize Australians to try to create more wealth through property and put roofs over other families' heads?
Yeah, exactly.
Oh, so ding.
Maybe we should think about that, right? Because they've been throwing the kitchen sink at investors for how long?
The poor old investors copped it. They're the Black Plague. How dare they be an investor? Well, who's going to provide your rental property?
Well, like I said, they're finally sort of thinking, maybe we need to provide some incentives for small scale investors, particularly rather than keep taxing them and putting levies and charges on them and making it hard to get a loan. Maybe we should go in the reverse. Doesn't this now reveal the horrific mistakes that have been made by policymakers in regard to trying to get rid of investors? They've now created this complete mess in the rental market to some degree. And now they're sort of shoving it into reverse, saying, maybe we need more investors. And I think, Graeme, we'll discuss this next week in a bit more detail, that because we're running out of time now, is that, I think the first group to cop it will be the Airbnb group. I think that state governments are now starting to think about, and Victoria's an example, well, maybe one of the solutions to get more permanent rentals is to hit the Airbnb market. And I think that there's now restrictions on Airbnb in Victoria of 180 days a year.
I had an interesting conversation with someone the other day, Doc, and they said, imagine, and this was just dinner dialogue over some wines, but they said, imagine if they implemented a policy that all of your interest was not deductible if you're in the casual pool. And I went, huh? Yeah. And they said, imagine if they restrict days, but imagine if it was relative to the letting periods, et cetera. That would absolutely discourage. There's lots of ideas, but I think that we're going to hear some interesting new concepts, as you said, restriction of days and restriction of claims. And but again, we'd have to look. We might have to look at the data, Doc, of the holiday let Airbnb casual letting pool of how much stock is in the market versus permanent, and would that actually still solve the problem or just put a Band-Aid on it?
Yeah, that's right. And look, as I think that it's just reflects the fact that we're now looking at other supply side initiatives, not just new build, because I guess they realise, well, new build's not going to fix it. We've got to look at other things such as getting more investors in the market and getting more permanent investors in the market. So we'll look at that next week, Graeme, but I think it's been very interesting in terms of those discussions. So we mentioned inflation was down again.
Yep.
It dropped headline inflation down to 4.9%. That followed a fall from 5.6 to 5.4 over the previous month, so heading in the right direction. But underlying inflation, which is the target range, which we look for that 2 to 3%, that 2 to 3% target is still at 5.8%, Graeme. The most significant contributors to higher inflation were housing and food. And by housing, we mean house building costs and rent. So they're still, a very sticky situation for higher prices. But fuel came down again, 7.6%, and that helped push inflation down. So it's just the adjustment from those high fuel costs from last year for inflation. And, of course, then we have our weekend auction markets to finish off, Graeme. As we mentioned, we've started the spring selling season. Good results there. Still favouring sellers, the market overall, and higher listing numbers as we do see over August, moving into the spring market, which is a precursor to spring. And certainly more robust results we can expect for sellers, particularly now the Reserve Bank has left interest rates on hold again. Sydney, 778 auctions in Sydney, Graeme. That's the biggest weekend number for the year so far.
Wow.
We've been breaking this year's records over the last month in Sydney. Still a very good clearance rate, 77%, well above a year ago. Also auction numbers of a year ago. Another big number of auctions in Melbourne. Just moved a little bit sideways, Melbourne, at 70%. It has been just a little bit under the mid-70s that it was recording earlier in the year, or certainly through that late autumn period. But I think that the Melbourne market will pick up a little bit from higher priced properties coming in, which they typically do later in the Melbourne spring season. And some early signs we've already seen more properties coming in from the inner suburbs of Melbourne into the market over the last week or so. And even last weekend's results were better for the inner south and the inner east. So we need to keep an eye on Melbourne going forward, which has just eased slightly. But the best part of the Melbourne season is yet to come in terms of the of higher priced properties. Brisbane, the same number of auctions, similar sort of clearance rate for Brisbane, but the Brisbane market is quite strong at the moment. And of course, we know it has a smaller.
Tell you what, I'm getting some confidence here again. That's done bloody well, very quietly through COVID, and still is Adelaide.
Yes, mate. Well, Adelaide's a quiet. Look at that Adelaide result.
Like
look at that, 93.6%.
But it's consistent, Doc. It's not phenomenal amounts of volume, but it is consistently clearing. It's consistently growing. Yeah. It's got a decent yield. I mean, Adelaide's Radelaide. It's rad. It's doing pretty well.
Yeah, no, it is. And it tends to fly under the radar a little bit, Graeme, but it certainly is a high-value market that continues to grow. And you can see those auction results, and the 90% plus is obviously out of this world a little bit, but we consistently see 80% plus in Adelaide anyway. So it's just a big weekend. Fewer auctions, maybe that activated more buyers for fewer stock. So a big result there for Adelaide. And Canberra, same again in terms of auction numbers, and a very similar result for Canberra. So some good portents for spring there. This is the trend. You can see how, as you mentioned earlier, Graeme, that August has held up in terms of clearance rate in Sydney. In fact, I expect to see a higher clearance rate in Sydney despite higher listings as September progresses. But that's really picked up from July. So it's actually strengthened through August, the Sydney market. Melbourne markets, just as I mentioned, Graeme, just fallen away a little bit from those mid-70s, but we need to wait to see the full spring effect to see if there's just some quietening of the Melbourne market. Brisbane market just holding steady at the moment going forward, but we know it's a smaller auction market, and it can't, and it doesn't necessarily reflect the big picture, although it does certainly tracking higher than a year ago. And Adelaide, look at that, 93.6% at the weekend, and continuing to track higher. Graeme, you're spot on there. That Adelaide market is certainly the quiet achiever and continues to rise. Look at that, right through winter.
Let's case study this, Doc. Let's keep an eye on this quiet performer. Yeah. Let's keep an eye on little Adelaide over the coming couple of weeks, maybe.
Yeah, absolutely. And it really hasn't lost a lot. We speak a lot about how strong southeast Queensland grew during the COVID period. But the Adelaide market also grew quite strongly, not as strong as Brisbane, but certainly it was not a shadow of, it was very close to what we saw from Brisbane. And Canberra, of course, just eased a little bit last weekend, but it's been steady in those 60s. You can get those on LinkedIn, on my LinkedIn account, Doc Andrew Wilson, every Saturday night. Full regional report for Melbourne and Sydney on Sunday mornings, and the national report. And of course, Graeme, as we usually state at the end of the show, there is our QR code for the little My Housing Market Infinity app, which will allow you to determine what about your house is worth currently. It has every suburb in Australia that has listings. It will tell you what the current asking price is, what the current asking rent is. It will give you the median, the high, the low, and the number of properties for sale or for rent in that suburb. And you can also filter it, Graeme. You can filter it for houses or units or townhouses. And you can also filter it for the number of bedrooms, 1 bedroom,
and that
4
app
bedroom.
is absolutely a buzz in our private community group, Doc, because people are like, how do I do this? How do I do that? How do I interpret this? So the Infinity family are having an absolute ball with that. So thank you.
Yeah. No, it's a great little app, and we update it constantly. So it's the data as it's occurring. But, of course, you have to go through Infinity to get the secret password to get access to it. So get onto that one, and it's a very handy tool to use. So next week we're going to have our rent report. We might actually look at the top capital city suburbs over August, Graeme, see where the top capitals or the top suburbs are in each capital. Home loans, we had some home loan data out last week. There's some issues with home loans which we will discuss in terms of first home buyers. They actually aren't revealing the first home buyer numbers, the ABS, so we'll talk about that. And, of course, we'll have the second week of spring auction results. So we've had a very busy week this week, Graeme, another busy week next week, and I look forward to discussing all the latest on the housing market with you next week.
And I'll tell you what, it's good to be back, Doc, and there's nothing negative happening in the market with the data.
No, it's all positive, and of course, just another good news story for the housing market is a pause in interest rates. I just mentioned, and I'll just finish off, Graeme, by saying I didn't sort of follow it up, but one of the issues Australia has is that we have higher inflation but lower wages than the US. So US real wages are actually increasing because their inflation rate is lower than their wage rate, right? And annual inflation rate. But we're the reverse. We actually have a significantly higher inflation rate than we have a wage rate, which means our real wages are falling. So this is an issue that doesn't get a lot of traction, but it's something I guess consumers will be aware of, that they're not really, on the data, and we can only go on that ABS wage index data, they're actually going backwards. But as you said, plenty are getting wage rises at the moment to cover those increases. But maybe we'll look at that in a bit more depth next week, Graeme, because I think I've just about run out of spit, mate.
Yeah, look forward to it. Well, it's good to be back, Doc. Appreciate it as always. And we'll rip into it again next week. Have a great week.
Yeah, good to have your comments, Graeme. Thanks again.
Thanks, Doc.